about divisional performance evaluation, what you're doing is that you are comparing one division or one department to another what? Department. Are you with me? So look at what in the department, which one is what? Which one is what? Doing what? Good. There are various types of centers in an organization. Okay? Various types of what? Centers in an organization. We have what we refer to as what? Cost center. A cost center is a department or person or individual or team for which cost to do what? Accumulated for. So, or on which behalf cost to do what? Incurred. So F3 or F2 class will be referred to as what? As the cost was center, because you are incurring cost on his what? On his behalf. So if the cost of the lecturer, the cost of the generator, the cost of the camera can be traced to F2 class, all those costs are incurred on behalf of what? F2. So F2 is the what? A cost center. We have what referred to as what? A profit what? Center. A profit center is a department or person or team where what? Which is referred to both revenue and what? Cost. So most of the time, your accounting department, because they don't bring you to the cost center, but your marketing department is a what? A revenue what? Sorry, a profit what? Center. They are both for what? Cost and what? Revenue. Then we have investment what? Center. Investment center are centers responsible for cost, revenue, and investment in what? Capital expenditure. They are responsible for what? Revenue, cost, and what? Capital investment what? Or expenditure. Now, what that means is that this person can decide to purchase or to do some things on his own without real consultation with what we talk what? Management. Therefore, most departments that you evaluate under divisional performance evaluation are what? Investment what? Center. They make profit, they make job cost, they bring in what? Revenue, and also take what? Capital investment what? Decision. Take for example Eleganza. Eleganza as an entity has various what? Division. We have what? The cooler what? Division. We have what? The barrel what? Division. We have the real estate what? Division. Each one of them invest in his what? Machinery separately. Each one of them bring in what? Income. Each one of them incur what? Expenses. Therefore, it could refer that each department is a separate what? Or is somehow what? Semi what? Autonomous. They might not have the full capacity to make their entire decision, but some decisions are left for them to what? To be made. Therefore, they are what? Semi what? Autonomous. This kind of situation, we might need to what? Evaluate this guy, whether this guy is doing fine compared to what? These other what? Guys. When you are comparing different investment sectors against themselves, what you are doing is what? Divisional performance with evaluation. You want to write something? Divisional performance evaluation is assessing the performance of a department or investment center. Are you with me? There are various types of centers in an organization. Various centers in an organization. These are one cost center. A cost center is a department, a person on whose behalf cost is being incurred. Most cost centers serve as backup centers to the main activity of the work. Most cost centers serve as backup centers to the main activities. Of the organization, e.g., account department, admin department. A profit center, that's number 2, profit center. Boss, just got by. I saw it yesterday in the class over there, and I saw it on the wall here. Sorry. If I define a profit center as a center that makes profit, will it make sense? A profit center is a center that makes profit.
It makes sense.
But you are not defining what it is. Now, the Ebola virus is a tiny organism that causes Ebola diseases. What is Ebola? Have you seen Ebola? I said written on the board. I was teaching us yesterday. I was laughing. I didn't know it was even published like this. That would save us. Now, a profit center is a department, a person responsible for revenue and cost. Responsible for what? Revenue and what? Cost. Then we have an investment center. Good afternoon, sir. Where have you been? The Germany. Okay. An investment center is a department responsible for cost, revenue, and capital investment decision. Investment decision. Most investment centers are semi-autonomous. They carry out their tasks. They carry out their tasks. There are two methods of assessing performance. Of assessing performance of a department or division. Or division. Number one, return on investment. How do you calculate return on investment? How do you calculate return on investment? PBIT over what? Capital employed. The same thing as return on capital employed. And so 100. That actually return on what? Investment. That is right. Yes. Now, one thing about ROI is the fact that when you are using for divisional performance evaluation, you will take the capital employed for that division, right, against the what? The PBIT of that what? Division. The division with the highest ROI is the best what? Division. However, you will also compare each division's ROI against the entire company's what? ROI. So if the entire company's ROI is 20%, are you with me? And division A has a ROI of 35%, B has 26%, and C has 51%. It means that division C has a what? A problem. Because division C is not achieving the what? The organization's what? ROI. In fact, it is division C that is pulling down the ROI to this what? Amount, most likely. Because every other one are above the what? The company what? Expected what? ROI. Are you now? That is how you use what? ROI. But using return on investment has some demerits. Are you with me? Because the composition of your capital employed, are you with me, is your net. I have been composition of your capital employed is your net assets somehow. In most cases, capital employed could be said to be the equity, are you with me, plus what? Long-term what? Liability. If that you reverse it, it means that capital employed is equal to your total assets minus what? Current what? Liability. Do you understand that? Now, talking about this now, a company can manipulate this total asset, this capital employed, so that it can achieve a significant high what? Return on what? Investment. How? A manager may not want to invest in capital what? In capital what? Assets. Let me give you an instance. Let's just start. Now, I have two departments. Are you with me? We have department A, Department A has assets after depreciation in year 1 to be $50,000. This asset is depreciated within over 5 years. Are you with me? Now, after removing depreciation, is able to generate a profit of $15,000 every year. Are you with me? It means that at the end of year 2, this asset, if I depreciate it over 5 years, what will the value? 40,000. Am I correct? Do you understand? If I depreciation with over 5 years, 50,000 divided by what? 5, I mean, that's about 10,000 every year. So you write off 10,000 as depreciation every year. The net value of the asset will be what? 40,000. I hope with you now. But you still make a profit of what? 15,000. At year 3, net value will be how much? 30,000. You make a profit of how much? 50,000. At year 4, net value will be how much? 20,000. You make a profit of how much? 15,000. Based on this, the guy didn't purchase additional asset though. Now let's calculate ROI based on this. ROI for year 1 will be what? 15,000 divided by what? 50 times what? 100, which equals to what? 30%. Am I correct?
Yes, sir.
Yeah, it will be 15,000 divided by what? 40 times what? 100. What would that give us? 37.5, I mean. In this is what? 15,000 divided by what? 30 times what? 100. That gives us about what? 50%. And this guy is what? 15 divided by what? 20 times what? 100. That goes about what? 75%. What do you observe? The ROI is what? Increasing. But the profit is increasing. What happens is that the guy just refuses to invest in more assets and he's not just depreciating his what? His assets. I see the problem now. So, and which means that for the guy to achieve a better ROI, all you need to do is just to buy more. You shouldn't buy more assets. Because if you purchase additional assets, what happens? The asset will what? Will go up. Are you here? So you shouldn't buy more assets. And if he does not buy assets, and the profits and the assets that are already used become what? Obsolete or breaks down, what will you use to make profit? Nothing again. You see the problem now? So ROI can be what? Manipulated. Also, assuming there's an asset that we need to purchase. Let's assume the standard this thing for this department A. Department A return is standard is 30%. Company's return is based on what? 20%. Are you now? Now, this company now wants to embark on the new project. The new project will require investment of let's say $50,000. Are you know? And then the profit on the new project or the returns is just about let's say 15,000 what? That's 12,000 what? That's the profit. Are you know? Now, let's look at it. This assuming is still in the first year. Are you with me? Department A, if he takes on this project, the investment will then become how much? 100 what? 1,000. Have it? Because you already have that many. 50,000. Are you following? The profit will move from 15,000 to how much? 27 what? 1,000, right? Are you following? The new project requires capital or investment of what? 50,000. Require what? Investment of about 50,000. But we're able to generate a profit of how much? 12,000. Are you me? If department A is the one that will handle this new project, are you following me now? The asset or the investment of capital department A will move from 50,000 to what? 100 what? 1,000. That is the additional investment from the what? From the new project. Are you me? The profit will move from 15,000 to how much? 27,000. That is the additional what? Profit from the what? From the new what? Project. Are you me? Now, the new ROI will then be how much? 27 divided by what? 100 times what? 100. That's what? 27 what? %. With this remindment of department A, want to do the project or not? You won't want to do it because what? It will reduce his what? His ROI. However, the project is good for the what? Entire company. Because the return on this project is 12 divided by what? 50 times what? 100. This equals to what? 24 what? %. Far exceeding the what? The one the company what? Requires. Far what? Exceeding the what? The return the company what? Requires. Therefore, all these deficiencies in ROI then led to another performance evaluation, our other technique known as what? Residual what? Income. Okay? Return on investment return on investment return on investment assesses an organization, but assesses a department by comparing the profit generated by the department against the capital employed or utilized for that department.
Profit generated by this department
against the capital employed or utilized in that department. Using return on investment to assess performance will adjudge the best department as the department with the highest return on investment, with the highest ROI. Also, comparison is done between each department's ROI against the total company's ROI. Against the total company's expected ROI. The department with the ROI below the expected amount, below the expected company ROI, department with the ROI that is below the expected company's ROI will need to be properly examined.